This is Satya Pradyuman of Cirrus Research. The latest issue of the briefing is just released. The briefing is a report that does a summary of market movement. We look at all the key characteristics, whether it be sectors or industries or factors, and also, importantly, our active blends. The title of this month's issue is High Rates Signal Rotation and Broadening. In our last few months, we've written quite a bit about the earnings cycle appearing to be a bit more stable, the likelihood that the Fed will not be cutting rates anytime soon. All of these things are adding up to some sort of a broader rotation that seems to be underway, moving from, let's say, a more growth-driven cycle towards a value-driven cycle. This chart, however, the cover chart, we think is important to recognize that rate risk is really becoming the driving force here in market leadership, which is that if the 10-year Treasury continues to back up, this is going to put severe pressure on the highest multiple stocks. We've already seen some damage in the month of September, and the reality, though, is that rates are sort of like driving this growth value rotation, and for that matter, also driving the broadening of the market. So if we continue to see an environment with more interest rate pressure, both of these elements, the idea that valuations should start to matter, because they'll offer protection, and the idea that you'll see a broader leadership just because some of the most expensive markets are at the very upper tier. So that seems to be playing through. Another element here has to do really with the pressures on active manager. What we've witnessed this year is a stark difference between the benchmark, the growth benchmark, and active results. We're seeing it in our own multi-factor models. A lot of that, what's driving this is the idea that valuations have not mattered all year. What we're now starting to see in the third quarter is some stabilization and reversal. The valuations are starting to be more relevant, and as a result, the active blends are starting to do better. We think if you do get a full-throated rotation towards valuations, a lot of these performance pressures will likely dissipate as investors become more and more fundamentally engaged. That has not been the case the first half of this year. With any questions, feel free to reach out to us. Thank you.